to today's explainer. We've got a lot of ground to cover, so let's just jump right in. We're doing a rapid-fire, top-down look at the macro forces that are literally resetting today's markets. We're talking massive divergences in global growth, some serious red warning lights flashing in the currency markets, and of course, we'll break down the exact technical levels you need for major pairs in Indian equities. So let's get into the overnight data.
First up, we're seeing a much broader market reset right now. Look at this sharp 3.3% drop in the Nasdaq. It really has investors asking the big question, is the AI party getting a little too crowded? Semiconductor stocks took a pretty noticeable hit just ahead of Micron's earnings report. And it's not just tech taking a breather. Safe havens like gold and silver are facing their worst quarter in years.
A huge driver behind these massive currency moves we're seeing is a rapidly widening global economic gap. The latest PMI numbers paint a really stark picture. Over in the US, the composite index just hit a 5-month high, pushing firmly into expansion territory. But across the pond, the Eurozone is limping along, sitting below that crucial growth line, and the UK is slipping even deeper into contraction. Basically, America's sprinting right now, while Europe is practically stumbling.
While that economic gap widens, geopolitical tensions are actually calming down the energy markets a bit. The US and Iran are currently negotiating a $12 billion frozen asset release alongside eased sanctions on Iranian oil. Plus, Oman just secured passage commitments through the Strait of Hormuz. Because of all this, Brent crude actually slipped below $77 a barrel. So, despite some ongoing noise and accusations between Israel and Hezbollah in Lebanon, this broader de-escalation is putting some serious downward pressure on energy.
Okay, so that brings us to a massive systemic risk bubbling under the surface. The US dollar is flexing, showing incredible strength. But the Japanese yen, it is stubbornly stuck right near the 161 mark. Now, you might be wondering, why should a trader focused on US or Indian markets even care about the yen? Well, historically speaking, a localized yen problem has a really nasty habit of quickly turning into a global liquidity crisis.
Let me walk you through the exact mechanics of how this plays out. Step 1. The US and Japan coordinate an intervention to strengthen the yen. But to fund that, Step 2 kicks in. Japan has to sell off its massive holdings of overseas assets, specifically US treasuries. When they dump those treasuries, Step 3 hits. Global liquidity suddenly tightens up. And finally, Step 4, yield spike, which simultaneously pressures the US dollar. It's a total domino effect, and you definitely want to see it coming. Section 1. DXY. Dollar strength at a one-year high.
Fueled by those massive US PMI beats we just talked about, the dollar absolutely surged to that one-year high. Tactically speaking, this chart remains a solid buy on dips. Your immediate resistance is sitting at 101.41, and if it pushes past that, the next ceiling is up at 101.80. But if we do see a dip, keep your eyes peeled for firm support at 101.89, stretching down to that critical 100.25 pivot level. On the flip side of that dollar strength, the euro-dollar pair has totally ground down to a one-year low. And the European Central Bank, they are caught in a brutal trap right now. They are hiking rates while growth is actively falling. If the July data comes in showing an even deeper contraction, the ECB is going to face a massive, highly politically charged policy dilemma.
Given that deteriorating fundamental backdrop in Europe, the tactical play here is absolutely sell on rise. You've got resistance sitting right at the 1.1388 mark, extending up to 1.1447. The pressure on this pair is tilted heavily downward, so any relief rallies are likely going to run into aggressive selling, at least until it finds its next major floor down at 1.1310. Now, looking at the British pound, it's feeling very similar heat. With Keir Starmer resigning, markets are pretty much brushing past the political drama and hyper-focusing on the frontrunner, Andy Burnham. Specifically, they are zeroing in on his fiscal stance. What are his commitments to defense and welfare spending going to look like as we head into September? When you combine that political uncertainty with those contractionary UK PMIs we covered earlier, the setup is a crystal clear sell on rise. Any upward momentum should hit a hard ceiling right around 1.3265. But the really critical technical floor you need to watch is 1.3150. If that level breaks, the chart damage is going to be significant.
All right, circling back to the yen for a second, because that intervention buzz we mentioned, it is officially real. Japan's finance minister essentially confirmed talks with the US Treasury, reaffirming an agreement to coordinate action in currency markets if needed. Make no mistake, they are drawing a line in the sand. Now, trading a chart when there is a massive fundamental intervention just hanging over it, that is incredibly dangerous. Technically, the structure is buy on dips with some support around 16.56, but you absolutely have to keep your stops tight here. A much safer tactic is buying only on a confirmed break above the 161.94 resistance, because if the Bank of Japan does step in, these support levels are going to snap.
Section 2. India markets, catching their breath.
Shifting our focus over to India, while their June PMIs showed growth that is cooling but still very healthy, the rupee is caught in the middle of a massive tug-of-war. On one side, you have this bullish US dollar acting as a bearish force, pressuring all Asian currencies. But on the other side, sustained dollar inflows from overseas FX deposits and external borrowings are acting like a powerful shield. It's a huge bullish force that's actively capping the rupee's depreciation.
Because those inflows are firmly capping any upward movement, the tactical view on USD INR right now is sell on rise. The ceiling up at 94.92 is holding very firm, while key downside support is sitting untested, down at 94.51. You're going to want to watch these bounds really closely, especially as global risk sentiment starts to shift. Flipping over to the equity side, the Nifty 50 just faced some broad-based profit booking, falling 1.16% to close at 23,824. Those early morning rallies met some serious heavy selling, with 14 out of 16 sectors dropping into the red. IT was a major drag, down 2.2% on weak global demand, and metals sank over 3%, tracking those global commodity pressures we're seeing.
That sell-off really accelerated once the 23,900 pivot broke, and that level now acts as immediate resistance right below the 24,344 ceiling. But don't panic, the broader structure of this chart still remains a solid buy on dips. You'll want to look for initial support to hold at 23,767, with a major, much firmer floor waiting down at 23,576.
So we are currently seeing these buy on dips structures holding up across Indian equities and even U.S. credit. But here is the critical question I want you to walk away with today. If the Bank of Japan actually pulls the trigger, liquidates those treasuries, and sparks a sudden global liquidity squeeze, will these technical structures completely shatter? Keep your stops tight out there, folks. Thanks so much for joining this explainer, and I'll see you next time.